Excellent in Asset Management Conference has been handing out awards to top talent in the industry. And right now we're joined by one of the winners, Larry Goldfarb, Managing Partner at private equity crossover fund, Baystar. Larry, good to see you.
Good morning.
Thanks very much indeed for coming in. Now let's talk about Baystar and what you do. You specialise in private investments in public equity. So essentially, these are public companies who have got privately issued securities.
Correct.
What kind of securities are we talking about?
It depends on the company, and the securities really are tailored to the particular company's needs. Usually they're growth companies. We see a lot of companies in the technology industry, fast-growing, and a lot of companies in the life sciences industries. They can range from something as simplistic as a common stock issuance or as complex as a senior convertible debt instrument, and it really depends on the needs of that particular company.
Okay, and this is quite a specialized business. How are you structuring it? I mean, what's the sort of the strategy as far as you guys are concerned?
The strategy is to negotiate some sort of incumbent optionality in the paper that we would issue. For example, we might buy common stock at a discount, or we might buy a convertible that trades into a discount. And what we like to do is hedge that piece of paper through a variety of methods to basically unlock the value in the discount that we were able to negotiate with the company.
Right.
It provides the company with quick cash, and it provides us with an insurance policy should there be some directional or credit problem.
Okay, I was going to say, why would a company issue equity to you guys at a discount? Is it on the basis that they can do it very quickly?
They can do it very, very quickly, and the cost of capital that we can give the company at is usually cheaper than the secondary markets, such as the syndicated convert market or the secondary equity market.
And what would your hedging strategy be? If say you got some discounted stock, for example, what would your hedging strategy be?
In the most simplistic form, we would sell the underlying common short in order to protect our long position. Obviously, it doesn't always work out that way, and we might have to go into the options market or do derivatives to put on a synthetic hedge in order to get that short position to cover the long position.
Is there any issue here in terms of protection of existing shareholders' rights?
We make sure that whatever exchange we're dealing on, and we deal on all exchanges, we deal with the regulatory rules that apply to shorting stock, and that there is a valid registration statement filed for the long position and the underlying common. Every exchange that we work on has separate rules relating to the issues you just raised.
And all securities are issued within the authorized but not yet issued category, so to speak?
Absolutely, although there are variations on every theme. The one very interesting thing about the strategy is no two deals are alike.
What about sort of public disclosures on the deals? How does that work?
It's very interesting. We, of course, file the appropriate regulatory disclosures that have to be made when we do the financing. But the financing itself is often a material event for these companies. These are normally growth companies, and they need the cash in order to invest in R&D, plant and resources, may possibly buy a company. And what we often see is the volume, trading volume, and the stock price go up just upon the news that there has been this funding, because what most analysts are concerned about in these companies are, do they have enough cash to effectively carry out their business plan?
So bearing that in mind, let's look at some of the companies then you've done recently. 2,002 transactions. XM Satellite Radio, what, $495 million in 2 transactions. Sirius Satellite Radio, $127 million. And Axonox, and that was a biopharmaceutical company?
Correct.
Okay, now, I mean, and that was $75 million in a couple of transactions. So you're at the sort of the pointy end of pointy end of investment. Yeah, these are businesses that are growing fast, are consuming cash pretty quickly.
These are companies in the satellite business for radio, for example. The infrastructural costs of getting the satellites up and getting them to transmit at the breadth that they do is phenomenal costs. They needed money. We could have no idea that the stock price would have gone as far as it did. That's not what we are. We're not a directional firm in which we're saying, okay, we're investing at $3 in an industry, and now the industry is going to have stock prices tenfold that. That is not what we do. We want to make sure that the investment at $3 is hedged, and should the stock price go up, as it's done in all these companies, that's good for the company and the shareholders.
And are your investors institutions or individuals typically?
They range. Our investors are typical hedge hedge fund investors, which range from very high net worth accredited individuals and institutions.
Can you tell us sort of the total funds you have under management at the moment?
We have a number of funds, but the flagship fund has $225 million of unlevered capital.
Okay, so you're sort of essentially a sort of a specialised hedge fund, which is quite interesting. Where do you see the trends this year going? Because you say last year has been pretty sort of exceptional.
Last year was robust because of the number of companies that came to market to raise cash in this methodology. It was around $20 billion.
But as the equity market, if the equity markets improve and access to other cash becomes easier, what does that mean for you guys?
Having gone through every cycle of possible capital markets and doing these exact transactions, there is always a sector of companies, usually in the small cap to micro cap. By that I mean from $2 billion in market capitalization to maybe $70 million in market capitalization, that always need cash, and for one reason or another, even though they're not distressed, because we do not do distressed, don't have time or the ability to access the capital markets. When the markets are flowing, maybe the big investment banking houses really want to do the bigger deals, for example.
Yeah, but that kind of suggests, though, that there's somewhere down, there's a breakdown in planning for these guys. You know, they didn't know they were going to need this cash. Which is, why would you want to put money into companies where the planning seems to have gone awry?
Well, I think a lot of people didn't know that they were going to need cash, as you say, and they thought they could raise cash at better prices. So it's not that they didn't know, it's at what price. And I think it takes a CEO and CFO and a board of directors a long time to get comfortable with a price in terms of raising cash.
And these are companies who often will have come out of private equity, been in the public markets for a year or two, and are coming back for a second round of financing.
That's right. Now you could say, well, why didn't they raise enough cash at the time when they came out? But they were looking at the price and say, well, we want to raise cash at a less dilutive price.
Do you find them, or do they find you?
It used to be I found them. Now they find me.
Okay, it's a sign of success. Larry, good to see you on.
Thank you very much
indeed, for coming. And Larry Goldfarb, managing partner at Baystar is the company. They're Baystar, if you wanted to know. Now, let's just divert attention away from the business arena, bring up to